Hi everyone, welcome to today's video. So the Sensex has crossed the mark of 80,000 this month and Nifty is about to cross the 25,000 mark itself. So given these numbers, markets are at their all-time high. And in this video, we'll be discussing about if the markets are overvalued or not and if there is a crash that is around the corner. Moreover, we'll be discussing about what we'll be doing with our investments, and the budget is going to be announced. So what is going to be the effect of that on the markets as well? So let's get into it. So first, let's start with the PE ratio. So this is one of the most common financial ratios used to check if a stock is overpriced or not. Moreover, if the markets are also overvalued or not. So price to earning ratio is nothing but it actually compares the company's share price to its earning per share. So let's say the PE of a company is 10. So this signifies that company is spending 10 rupees to earn 1 rupees, or it will take 10 years for investors to make their money back if the earnings are constant. So most of the time it is said that the PE ratio, if it is around 30 or less than 30, that means that the company is not overvalued. But is that even true? Well, according to me, this is a totally incorrect statement because PE ratio should be compared for a given company around different times. We should not compare PE ratio of different companies and say if a single company is overvalued or not. For that, a simple example would be Nestle. So we'll see that the stock PE is 78. So we can say that the stock is overpriced because it is well above 30. But if we look at the history for the PE ratio for this particular stock, we'll see that the average PE. So here in the graph, we can easily see that the median PE for Nestle is around 80 and it has been going up and down in that range itself. Now, does that mean that Nestle was always overpriced? Well, the answer to that is actually no. So it would be a better criteria to compare the PE ratio of a particular company in given different time frames rather than comparing PE ratios of different companies and saying that one company is overvalued or not. For that, if you go through this, so the same thing that I've just discussed, you can also read here in the limitation of using the PE ratio in the article of Investopedia. So here you can see the main limitation is comparing the PE ratios of companies from different sectors. And this is one of the main limitations because the companies in other sectors grow at a different pace. So it is not suggested to compare the PE ratios of companies of different sectors, rather to compare a PE ratio of a single company across different time duration. So next we see if in the Nifty 50 chart as well, if we look at the PE ratios, we can see that the PE is median is 22.5 for the last 1 year. And again, if we see in the last 10 years, the median PE is 23.5. And before before the COVID pandemic, the PE for the market was high at a high of 30. But after that, it was again in 2021 was around 40. But if you look at the current scenario, the PE ratio of the market is at its median. So from here we can easily conclude that the markets are not overvalued if we look at the current PE of the market and how the companies are performing in the Nifty 50 index. Moreover, if we look at the HDFC Bank, which is one of the big stock in our stock markets, we'll see that it has corrected a lot in the last few days and even a 5% correction in a single day. So what we'll see from here is that in the last 1 year, the price of the HDFC Bank has remained constant, which is around 1600 or so. It has rallied between 1800 to 1400 in last 1 year. But if we look at the P ratio in the same duration, we'll see that in the last 1 year, the P ratios has gone down significantly. So in the initial days, P was at 28, but now the PE is around 18. So From here, we can easily see that PE is price over earnings. Here, the P price has remained constant, but earnings are constantly growing for HDFC, because of which the P ratio is going drastically down. So again, we had seen a correction in HDFC Bank in the last few days, but the PE ratio is quite healthy and earnings are quite healthy as well for the bank. Moreover, if we look at the profit and loss of HDFC, we can see that the compound sales growth for the bank is 70% for the last 12 months. Compounded profit growth is around 40%. So fundamentally, the stock has been doing good, and we can see that the stock price has fallen down, but in the long term, it is going to gain what is expected fundamentally from the stock. So this was the discussion about the P ratios on the markets and the HDFC Bank, in which we had seen a minor correction in last few days. And same is the situation with the overall markets. We have not seen that the PE ratio is drastically high for the markets as well, and there is no sign of crash that could happen in the upcoming days. And so now let's talk about the one other factor that most of the people are talking about, is that Warren Buffett is sitting on a pile of $189 billion, which is a huge amount of money. And it is said that he's sitting on this pile of money because he's sensing a crash that could happen in the near future. But if we look at the portfolio of Berkshire Hathaway, we will see a interesting trend. So this is a graph that talks about the market cap of Berkshire Hathaway and the cash equivalents that that particular company is holding. So here we can easily see here in 2005, 2006, it has been sitting at 35% of the total market cap of Berkshire just before the Lehman Brothers crash or the financial crisis of 2008. Similarly, just before the COVID period, the percentage is around 30%, but as of now it is just 21%. It is nowhere near the high of 40% in 2005. So this is one of the weak factors which should be taken into account when we are speaking of a crash that could happen. But what we could learn from this is to have some kind of opportunity cash, we or some kind of liquid cash that we should have with us in case there is some minor correction that could happen. Now, if we look at the Nifty chart, and here we'll see that in the last 1 year. So here we can see that there has been a 10% or 5% crash in the markets that we could see in last 1 year. And if we look at in the last 5 years, what the chart has to say. Now, if we look at the past year, which was 2022, last to last year, we can see that there was a correction of around 17-18%. And this is the type of correction that we can definitely face in the near future, because markets are at all-time high and the budget is going to be announced, sensing that there can be a correction, but timing that correction is going to be super difficult, and we cannot time exactly when this correction is to happen. So the best thing to do to benefit from that correction to happen is we should have some kind of opportunity cash like Warren Buffett, and we can use that cash at these times. Okay, so concluding this video, we can directly say that the markets are not overvalued as per the PE ratios that we have had a brief discussion. And the PE is around at its median level, as we have seen in the last 10 years. So the next point is that PE ratio should not be compared with companies across different sectors. Rather, as we have seen, for the example, with Nestle and all, these companies are trading at a PE of higher than 50, around 70 and all, and they have been doing pretty good in last few years. So the P ratio should be compared for that particular company in the for different time periods, because if we see these kind of news that 104 firms trade over 50 PE, so it would be better if we look at the financials and not just at the PE ratio, because every company is different and the growth story of every company is different. So it would be better if we look at the financial data for all the companies. As we have seen for the HDFC Bank, the price is constant, but the earnings are increasing for that, and hence the P ratio was going down. Similarly, we can see the companies, what is their growth story is like, what are their earnings, and what are the price at which they are trading. Rather than comparing these companies according to the P ratios, we should be comparing them based on their fundamental data. And the last point that will be concluding from this video is going to be that correction can happen anytime, and we cannot time exactly when the correction is going to happen, but around 10% correction we can expect is going to happen in the upcoming future. So for that, what we can do is to have liquid cash with us, so that whenever we found this kind of situation of 10% correction, we can easily pick up stocks with the fundamental data at a bargain price. Okay, so that's it for today's video. Let me know your thoughts in the comment sections below, and see you in the next one.